Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
We know that there is a certain amount of chaos in place, especially around the oil prices. And we spoke last week about demand destruction mode and how some countries had taken measures to reduce the strain on oil demand, particularly in Asia, where they had reduced work weeks. And we can see that the dramatic fall in the price of crude just shows how much this oil price was contingent on the escalation of hostilities in the Middle East, that there has been a sell-off for the ages, essentially, in crude, and it fell only more during COVID and when Desert Storm had started, so 1991. So we can see here, looking at the 2026 fall in price, this has been around the 8th of April, down 15.8%. So very dramatic fall in price, suggesting that there was an ebullience around the expectation for a positive outcome here. So this kind of volatility contrasts starkly with the low volatility that we've noticed in equity markets as well as bond markets. So oil price volatility has now become a new normal. And I would suggest that chaos around geopolitics, starting with the unconventional foreign policy propagated by President Trump, following on to Davos and the seismic speech by Mark Carney, suggesting that we now had a rupture in international world order and that we now need to be thinking about resetting and restating that. This type of chaos and type of disruption seems to have been normalized by markets such that they are not reacting in the same way. And as we noted before, the sell-off in the run-up to the current conflict was dramatically less than we've seen in the case of other conflicts. So markets acting with a lot more stability, even in the face of unprecedented hostilities. However, there is going to be a redrawing of some of these lines, and this is a suggestion perhaps that we are now entering a phase of deglobalization 2.0. Starting with emerging markets, as I noted before, most dependent on Middle East oil. They had rebounded sharply from the conflict-induced slump, but there was some distinct differentiation in place around markets, around certain markets that were more dependent on the oil than others from this region. So we've seen before a distinct differentiation within emerging markets around tech. We know that China and Taiwan had been, and Korea in particular, had really been moving in sync with the US tech trajectory, whereas other emerging markets were seen as much more frontier, much more exposed to the traditional industries, the export-import dynamic, as well as being exposed there to the strength of the dollar. As the dollar has been strengthening, we know that this would generally disadvantage some of the countries in these regions. So looking also at the portfolio flows, we've seen the portfolio flows into emerging market assets plunging to their lowest since the pandemic. So in the aftermath of the outbreak of hostilities in the Middle East, we saw a reversal of some of that rebalancing trend or rotation trend that we'd seen out of the US into emerging markets. So emerging markets had seen a very strong start to the year, and they had generally been supported by strong flows. Much of that has reversed. I should note that this does not apply to some of the more developed markets outside the US, such as Tokyo, which had reached new highs over the course of the last few months and have particularly rallied strongly as over the course of this week. It's interesting also to think about dependencies, because as we think about the dependencies on the Middle East and the Strait of Hormuz in particular, this is where concentration and being overly dependent on one source for energy has seemed to be a real frailty in global markets. We've already seen this in the outbreak and the aftermath of the outbreak of the Russia-Ukraine conflict, that many European countries in particular started to rethink some of their dependencies around natural gas and oil and redraw those dependencies essentially. If we look at where the exposure to the Strait of Hormuz is, clearly it has significant strategic significance in that 22% of global LNG trade had transit that corridor, 25 to 30% of global methanol and polyethylene precursors, 15 to 18% of ammonia production capacity, and 25 to 28% of nitrogen-based agricultural components. So this, by any measure, represents significant concentration on that corridor in terms of supply.